Can I ask a question? Is there anyone else in the queue?
Fire away.
Yeah, I'm going to get really granular and specific. So we have a fixed mortgage and we have 16 months left, and then it's a fixed variable combo, and in 16 months, it's going to flip over to a variable. And just wondered if you have any thoughts about how you can predict if that's a smart thing. Should we lock it into a fixed? It's at about 3.5%, and we have 23 years left on it.
Yeah, with evaluating
That's really specific, isn't it?
it's actually, it fits really well into because it goes back to, is your loan a loan that's going to be sold to Fannie Mae or Freddie Mac? So right now in the Bay Area, the max loan size for a single family home is $765,600. So if your loan amount is above that,
yes, it is.
So your loan is considered a jumbo loan. And if you were to call, banks and lenders, they would tell you, hey, we're not. A lot of them are not focusing on jumbo refinances, especially from non-bank lenders. So like
ours is with Wells.
Yours is with Wells. So I'm pretty sure Wells is actually charging a lot higher interest rates on their refinances than they are on their purchases. But you can look into that. So when you think about whether or not there's really, your question kind of comes down to evaluating the refinance opportunity. And the way that I like to think of a refinance opportunity is if you are able to lower your interest rate and it's not going to cost you any fees, then it's never a bad deal, even if that means restarting the clock on, let's say, to a 30-year fix, because you could always just make your payments, you could always just pay more and you can pay off the loan faster and there's no prepayment penalty. And I know that sounds kind of simple, like no duh, if you can lower your rate and you're not paying anything, but there's like 10 million homeowners that are in that exact situation right now that don't do it, because they have it in their mind like, oh, I need to lower my rate by a full 1% or whatever their arbitrary number is to achieve their goal of the refinance. With your situation,
and I should add, I'm older too, so I will be paying if I have to keep paying 30 years. I'll be paying in my 70s, which I really prefer not to be doing.
Of course, and that so it really depends on the goal. So because holding a mortgage is not necessarily the really bad debt, because you can write it off against your income, but some people are wired differently. So my brother is kind of like you. He just wants to be done with the mortgage, and he's got a super low interest rate. And I'm like, hey, you'd be better off putting that money elsewhere and just paying the minimum on the mortgage. But from his standpoint, he gets satisfaction of having a lower loan balance, more equity in the home. I think for yours, we're going to see the bond market begin to normalize for jumbo refinances. And so I would maybe hold off. You could always compare with Wells and other big banks, because your loan is not a conforming loan, and see what they have to say, whether or not they would be able to refinance you into a fixed rate at, without paying a lot of fees, and to keep your rate either the same or even lower it. But I suspect right now is not necessarily the best time, just because there isn't a lot of competition for those jumbo refinances.
I have a very ardent desire to take it away from Wells, and don't think Wells is worthy of my money in light of all the things that's been happening with them. So that's a little bit of a political statement. We'll keep among this group. But yeah, I don't. They're in the news a lot lately. So I think at the beginning you said, and I want others to ask questions, that you wouldn't necessarily stay with the large banks, right? I know someone else is on this call who I know, and he's with a large bank.
Yeah.
Aren't you saying that may be the worst choice?
It's a little unique because we're in the Bay Area, but the mortgage market is so big, and if the loan is a loan that fits the conforming guidelines, and when I say conforming, that means it conforms to the Fannie Mae or Freddie Mac, then often you're not going to get the best deal from a large bank. If your loan is a private loan, so meaning it's a jumbo loan, so it's above that $765,000 loan amount, which a lot of Bay Area loans are, then big banks are in a much stronger position to offer the best terms because they have the lowest cost of capital. And so I kind of bring up this idea
Got
of
it.
really
Thank you.
knowing about the secondary market is kind of the key aspect of knowing where to shop, because if it's a Fannie Mae loan, then effectively we're all brokers. Quicken Loans is a broker to the government. Wells Fargo is a broker to the government, and big banks are notoriously slow and inefficient, and so they have to have that inefficiency priced into their margins. So that's really kind of the key. Now, for a jumbo loan, same thing. The comparison shopping is obviously going to be important, but then there's things like relationship discount. So like First Republic will say, oh, if you put $1 million in and you keep this, then hey, we'll knock off your rate by 0.25% or whatever it might be. So we kind of live in the mortgage market of the Bay Area is very different than the United States as a whole.
Thank you very much.
I have a question.
Yeah.
Can you hear me? Okay.
I can hear you.
Can I do a very specific question like she just did?
Yes, of course.
Okay, so I have a Freddie Mac, JP Morgan Chase, 4.875% and 40% equity. What I want to do is, and I'm wondering what your thoughts are and what you think is going to happen for after, when we start the bounce back. There's going to be millions of people that instead of we're not going to foreclose or anything, but there's going to be millions of people that are going to foreclose or they can't catch up and so a refi would solve that problem, right? You're getting a big chunk of change and then you can use that to pay your bills and you can lower your mortgage and all that kind of stuff. So kind of my goal is to do a refi, not now, but later. I'm not in the Bay Area, as you can see. Mm-hmm. I'm up in the mountains. But we're self-employed. So, we're a new company, we're launching, so we don't have that paycheck thing that they want.
Right.
And so back in, the before the crisis, when you could just your accountant's like, oh yeah, she paid her bills and you got a house, right? Do you think that it's going to get easier? I know right now they're tightening up because there's no money coming in from anywhere across the globe. What are your thoughts on the bounce back of this whole for getting, are they going to tighten or are they going to loosen? What do you think?
100% they're going to unequivocally tighten their underwriting criteria. And that's what we've seen, and probably the biggest change since the coronavirus happened, where the private mortgage market has almost evaporated overnight. And there used to be companies that specialized in lending to self-employed borrowers like yourself. And it goes back to this idea of loans that are sold to Fannie Mae and Freddie Mac are not necessarily a terrific measurement of risk. So somebody who's putting 3% down with a 620 credit score, who's been in their job for 2 months, that person may qualify for a Fannie Mae backed loan. But someone in your case, where you have 40% equity and maybe a terrific credit score and good income coming in, would not be able to qualify for a Fannie Mae backed loan because of the recent self-employment. Most for a conforming loan, you have to have 2 years self-employment. So it opened the door to these large companies that were now going to do loans that say, hey, this doesn't make sense. We're going to start doing loans, and they called it non-QM, so they call it non-qualified mortgage loans that don't meet these standards, but are still very low risk, and we can give them a low interest rate. It won't be as low as maybe what it would be on a conforming loan, but it will still be commensurate with the risk. And that market has really disappeared, and I don't expect it to come back at least until the fall. And the people who I've talked to who were in that market, they are all transitioning away from the non-QM lending space and moving into conforming origination companies where the companies are just doing the loans that conform to Fannie Mae and Freddie Mac.
this is where I get confused, because from like a business standpoint, it makes sense to me that they allow people to refi, because here you've got some equity, right? But you don't have cash. And so instead of making all the people that you owe money to, you just refi your house, you have this chunk of change, and then you can pay all those people. And then like millions of people do that. So that's why.
I completely agree. I mean, my personal take is if you're not pulling cash out and you're lowering your interest rate and you're already making your payments on time,
Yeah.
let's say you've made a 12 months of payments, then it should be, you shouldn't even really need to requalify for the loan. You've already demonstrated your ability to
Yes.
pay, and now the payment's going lower. Unfortunately, the secondary market doesn't see it that way. And so it really just comes back to how big of a role the federal government has in housing and in mortgages. And so that's why I really kind of wanted to highlight this slide, because it's a big misconception. Someone like I get inquiries all the time from folks who are like, oh, I have great equity in the house, and if it doesn't meet the guidelines, there's no wiggle room, and especially now that alternative market is really shrinking. So some banks might be doing it, like large banks, but for the most part, banks are really tightening their privatized, box of what they will accept on a loan that's not going to be sold to Fannie or Freddie.
Huh.